Thanks for clicking. All eyes were on the Bank of Canada this morning as it was set to make its final interest rate announcement of the year, with many predicting the bank would raise rates by 25 or 50 basis points. We got our answer at 10 a.m. this morning when the bank raised rates by 50 basis points, bringing the policy rate to 4.25, the highest Canada has seen since 2008. This puts our prime rate at 6.45%, 4% higher than it was this point in time last year, which will obviously put even more pressure on holders of variable rate mortgages. But is this the end? Is this going to be the last rate hike we see from the Bank of Canada for the foreseeable future?
Stop asking.
A brief look at the interest rate announcement at this point in time last year, when the Bank of Canada predicted we'd be at a 2% inflation point at this point in time this year, shows the Bank of Canada doesn't really know either. They don't know how high they're going to have to go. It will all be based off of the inflation rate. And we've received a number of reports over the past couple days, past couple weeks, showing that the inflation outlook for 2023 is a mixed bag at best, with many of the reports showing continual inflationary pressures, but some positive signs emerging. So what I want to do today is go over the Bank of Canada's inflation rate announcement, go over some of the major factors impacting inflation in 2023, and then discuss what to look for next. Speaking of next, we are expecting to get Canada's national real estate data out next week from the CREA, and we'll obviously have updates out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this announcement. As mentioned, the Bank of Canada raised interest rates this morning by 50 basis points, bringing the policy rate up to 4.25%. As for what comes next, the bank issued a statement saying that they will consider further rate hikes to bring the inflation rate back to target in 2023. The statement also expressed the bank's resolve to get inflation back down to their 2% target range. So the bank is still committed to a 2% target for now. The 50 basis point rate hike will no doubt lead to even more calls for the bank to pause its path of rate hikes over fears of over-tightening and potentially wrecking the economy.
Call a press, put out a press release.
But let's be clear, the Bank of Canada, unlike last year, is leaving the door wide open for further interest rate hikes should inflation persist. And the inflation rate for 2023 is highly unpredictable, with some negative and some positive reports coming in as of late. We just recently received a report that the price of food, which represents 16% of Canada's CPI, is expected to rise between 5 and 7% next year. With that said, the same report that was issued last year also predicted a 5 to 7% increase in food this year, and food actually increased 10.1%.
Everything that guy just says is bullshit.
So with food prices constituting 16% of the CPI basket and showing no signs of slowing, it's not clear that the inflation rate is going to get a lot of help there. The shelter component of the CPI, which represents about 30% of the basket, also shows no signs of slowing either. Mortgage costs, property taxes, and rent prices are all up all across the board throughout 2022 and showing very few signs of slowing. Mortgage costs are already up, especially for holders of variable rate mortgages. We've all seen local stories from our municipalities struggling with higher costs, planning to raise property taxes throughout 2023. And of course, rental prices, which skyrocketed this year, are showing no signs of relief either. So similar to food, it's not clear that the shelter component, the most important component of Canada's CPI basket, is going to show any relief next year either. So between food and shelter costs, we're at 40% of the CPI basket, and this isn't to mention that wages are continuing to accelerate as well. Last week's report showed that they accelerated at 5.6% in the month of October, which was the 6th month in a row that Canada's wages accelerated by over 5%. This is obviously going to be disconcerting for the Bank of Canada, which is ultra concerned with the potential for a wage price spiral, where wages work their way into the price of goods, leading to a higher price of goods, which leads to more demands for higher wages, ultimately putting even more pressure on the inflation rate.
That sounds like a you problem.
So between food and shelter, 40% of the CPI basket, and persistent wage pressures, we're not seeing a whole lot of positive news for the inflation rate in 2023. With that said, the transportation component of the CPI, which represents about 17% of the CPI basket, is showing some positive signs, with the price of used cars continuing to come down, and we're seeing some relief at the gas pumps as well. With that said, the price of gas can and does swing wildly, and there's a lot of uncontrollable factors, unpredictable factors at work which dictate the price of gas. Saudi Arabia, the USSPR, China's zero COVID policy, not to mention Russia. Where the price of gas will be in 6 months is massively unpredictable. So, in summary, there is a lot of pressure on Canada's inflation rate going into 2023. Between food, shelter, and wages, we have a lot of factors pushing up our prices. Now, that's not to say that inflation won't come down in 2023, but it's not clear that it comes down enough that the Bank of Canada will be able to pause. The big news coming out of CTV this morning was that Canada's policy rate was at its highest point that it's been since 2008. However, if we look back to 2008, the inflation rate was 2.4%. If the Bank of Canada raises its policy rate by 25 basis points at its January meeting, which I think it will.
Well, I'll remember that.
But let's say that our policy rate goes to 5% and our inflation rate is sitting at 6% or even 5%. Does the Bank of Canada maintain its pause when the policy rate is at the same rate of inflation? It's not clear that they do. The Bank of Canada's mandate is 2%, and right now we're at 6.9%. That's a long way from 2%. Even if we're at 5%, that's still a long way from 2%. People would have been losing their minds a year ago at a 5% inflation rate. And we saw in 2008, the last time we were at 4.75, inflation was 2.4. So there's still a wide spread between our policy rate and our inflation rate. And it's not clear that the Bank of Canada will allow inflation to remain sticky throughout 2023 and maintain the pause on interest rates. With that said, we will continue to track the Bank of Canada in its moves to combat our inflation rate throughout 2023. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.